I was reading in a stat that 50% of the fundraising are stopped not by anything else, but because the books are not in the ready state.
So if you are a private limited company plus you have a GST and you have 10 or more employees, means at least 60 plus compliances you need to do in an year.
During raising of the funds, the due diligence is done for how many years in past?
From the scratch, zero, from day zero.
So when a Indian company is onboarding a director from outside India, so what additional compliance come with this? And Satish, what is the biggest hurdle from awareness to ownership? So a founder is aware what all needs to be done, but still there's a gap in knowing and doing.
Yes, two things. Few people overthinks. They will do micromanage and overthinking. Second thing is completely they will ignore. Let's see whatever comes.
Funding doesn't come just from idea or execution. It comes from the structure beneath it. Most of the founders find it hard way. The term sheet is on the table and the books could not survive the second look. My guest today on this podcast has spent years ensuring founders are ready for that moment. Satish, welcome on this podcast. Glad to have you here today.
Thank you so much for the introduction, Chetan. Hello, viewers. Welcome to this podcast.
So Satish, beyond your LinkedIn profile and the elevator pitch, when an old friend of yours asks you, what do you do? How do you answer?
Oh, that's a great question. So I'm not that kind of person what you saw me 2 decades before. Now completely engaged, committed, dedicated towards business owners, entrepreneurs, building something great for the nation, for the world.
So Satish, coming to the capital, the funding, which is your niche. So for to be ready to get the capital from the market, also from the foreign investors, what do founders typically miss where you come and help them?
The important thing they miss is their next 3 years, 5 years plan. So they simply come up with an idea. They're looking for the investor. They are not understanding how the entrepreneurship or method of making revenue. They should understand the fundamental of the finance. First, they have to maintain the data. And more importantly, they should be a private limited. So people think if they are proprietor or they are a partnership firm, so they can raise funds. It doesn't work in such a way. Okay, they should be a private limited company. Even LLP can raise funds, but the share tradable concept is not there. Investors mostly won't invest in LLPs because in private limited only they will be willing to invest. Why? Because in the next further rounds they can raise funds. Company can raise funds. These investors will get exit. Okay, this is the first and foremost thing. The founders will miss this important item. Second thing is due diligence. This is the another important thing founders will miss out. What is due diligence? Due diligence is very simple. How you do a full body checkup for your entire body, health related and everything like that. The investors will do for the company, like financial due diligence, legal due diligence, compliance due diligence. On the product, what you are going to build, that due diligence, you will have prototype. In finance, they will check each and every item from data entry to how you are maintaining your accounts and the financial statements and the supportings based on what you have created the financial statements. Second one, the legal due diligence, all the legal documents between you and the other stakeholders. Stakeholders means what? Employees, service providers, vendors, suppliers, customers, bankers, and etc. Because if you're not having any kind of agreements contracts means then if it is not defined means the liability might create in any way. That is the legal due diligence. Third one is compliance due diligence. So if you are a private limited company plus you have a GST and you have 10 or more employees means at least 60 plus compliances you need to do in an year. Under income tax, TDS, GST, ESI, PEF, professional tax, like this. So founders used to miss these compliances, especially the professional tax and also ESI, and even some people would not file the ROC also. Next one is product due diligence. So if you're building something like a software means you should have complete details, how you arrived at this application idea from wireframe to deployment, everything should be documented. So due diligence part and the company part, these are the most important thing most of the founders used to miss out.
Satish, if someone started as a LLP or one person company and then they grew in the process and then they are thinking about raising the fund or capital, is there a way they need to open a new company or they can convert? What do you typically suggest them?
Okay, so there are two ways. In your question itself, we have answers. Either they can convert from LLP to private limited or OPC to private limited. Otherwise, create a private limited and acquire that LLP or OPC. Either way is possible.
Sure. So, Satish, another thing which you mentioned about the diligence at the legal, product, finance, various levels. Now, I mean, I believe some of it, every founder will take care of it. If we come to the accounting or finance, the tax, the GST will be taken. Is that minimum enough, good enough to lead them to the funding also? Or there are steps which typically a founder miss?
So next important thing the founder misses founders agreement and also shareholders agreement. So there won't be any predefined agreement between the founders and the existing shareholders. That is the one important thing they miss. And also while going for the investment, they are not looking into the term sheet issued by the investor and also the shareholder agreement issued by the investor. There are several clauses. They should carefully go through each and every clause. So these are the two items founders used to miss out and they will regret in future. And most of the companies are collapsed or closed business or dead because of founders conflict. In a good amount of companies are closed because of investor founder conflicts also.
Yeah, I was reading in a stat that 50% of the fundraising are stopped not by anything else, but because the books are not in the ready state.
Obviously, because that is the see. I will tell good example. Say for example, someone did not do a three kinds of compliance. Like he moved from actual register office to some other office, and he just changed in his all his legal documents. Okay, he didn't update it with ROC. That is one thing. Second one is he is not doing the books properly, and for that reason he didn't file the cash flow statement. Cash flow statement means it's a part of financial statement. P&L, balance sheet, and cash flow statement. And third thing is he didn't renew his DIN like that he didn't do for so many months or even a year. The penalty could come up to 10 to 15 lakh rupees based on the seriousness if the ROC finds out. Okay, if someone is going to invest in you 1 crore means if 15 lakhs is going to be paid as penalty means 15% is immediately bounced out. That could have been invested in marketing, that could have been invested in R&D. Why it should be paid against the penalty? Okay, if he is not disciplined, means basic hygiene and compliances, how he will safeguard the investors' money? And more importantly, in due diligence, most of the investors will do it through a service provider like us. We used to do even the credit score due diligence of the founders also. Founder is having a bad credit score. What does it mean? If there is a bad credit score, means what does it mean? Yes, they are not repaying. That's the thing.
They are
Okay.
not repaying.
If someone is investing in you, and what happens if the banker comes and stands in front of your company or home, means what you will do? You have a cash, then you will take and you will repay. Then what happens? It is going to someone other than the business. So that also threat. So this is how the due diligence, bookkeeping, finance, founder agreement, shareholder agreement plays a very vital role.
Satish, when a company grow, let's say growing from one location to multiple location, growing from 100 people to 200 people, or maybe opening one more entity in offshore location. Now, what is the impact of this growth on the compliance cost?
So, if it is some foreign subsidiary means there will be additional FEMA related. FEMA means Foreign Exchange Management Act related compliances will come. The first one is if any investment is done by the foreign company or foreign shareholder means FCGPR should be filed. Okay, one time filing. Second one is every year they should file the FLA return, Foreign Liability and Asset Return, and also the transfer pricing should be should be filed. That is with the income tax department. These three are the inevitable thing. And Form 61A for the directors foreign company who became the director in Indian company foreigner, we need to file. So these are the basic items. Other than domestic companies, we need to file. If there is a subsidiary of Indian company itself means Indian domestic company is having a subsidiary means there is a couple of additional forms that is a regular one. And we have to replica whatever we are doing, GST, income tax, TDS, same thing to the subsidiary also.
And Satish, you work with the Indian founders. You also work with the investors coming from outside India, right?
Yes.
So you also work with the foreign accounting firms.
Yes.
Now, when a founder is typically looking for raising fund from a foreign investor, What additional bookkeeping due diligence they should be aware of?
Before that, there should be a crystal clear communicator, because mostly this US North American investor expects a good email communication. But in India, the basic culture is, if anything, they will just call, they WhatsApp, they will do these kind of things mostly. But they prefer email. So we are dealing with several European and North American clients like US, Canada, and all. We were doing communication, in most of our communication, 99% is mail only, hardly 1% only we are doing through calls. That also video calls, it will be crystal clear. Okay. Next one is, the founders must keep everything clearly, okay, because they are very straightforward. Okay, we can't do any sugar coated things and all. So if it is going to work, you tell them. Okay, if they are onboarded as investor, if something is going wrong, means inform them what's happening. Just inform them. Once it gets worse, don't inform that time, because if some problem is happening means, and you are a genuine, honest means, they will appreciate. Okay, they will give some ideas, they will network, they have a good network, they will pull out those network to solve this problem or issues. So in one way, the founders who are expecting investment from abroad should be straightforward. That's it, honest and straightforward.
The transparency, honesty,
Yes.
straightforward, and also, as you said, keep the written record of everything, not just the verbal communication.
That is, yeah, yeah, yeah. That's important. And mostly those people, not mostly, 100% they prefer, especially these US people prefer documentation. And they are 100%, they want to be a 100% compliant.
So, Satish, let's go to a scenario when a Indian company is onboarding a director from outside India. So, what additional compliance come with this?
Okay, very great questions. There are few things you must note it down. First one is whether the director is from the land border sharing countries or not. First thing we have to need. If he's from Bangladesh, Nepal, or China, means we need to get the Ministry of Home Affairs clearance. It will take some few months. Okay. If he is not from land border sharing countries, means pretty straightforward. Okay, we need to collect their KYC. MHA clearance is not required. So, what are the KYC documents required? First one is passport. Second one is their bank statement. One day statement also sufficient. Their bank name, address, the director name, address should be there. The reason for getting the bank statement is for the identity proof from the third party. It's not to see their check their bank balance. Okay. Third one is their national ID card. Fourth one is if they have driving license, they can give, and mobile number, email ID, and passport size photo. So once we collect this document, just go through it, the validity. Okay, if everything is fine, ask the person to get a notary in all these documents if they are from Commonwealth countries. If they are not from a Commonwealth country, means additionally they need to get apostle. Okay, notary plus apostle. If they are from non-English speaking country, means they must translate this document to English, and in the original document and the translated document they need to get notary and apostille if they are not from non-Commonwealth countries. If they are from Commonwealth countries, only notary in both the documents sufficient. For example, UK is a Commonwealth country. Notary is sufficient. Okay. Let's take one non-English speaking countries, Spain, and let's pretend it is not written in English, and let's pretend it is not from a Commonwealth country, means they need to translate their documents into English, and they should get notary and apostille in both the documents. If they are from USA, it's a non-Commonwealth country, but translation is not required. Why? Because they are English speaking country. So notary and apostille is sufficient. Okay. Once these documents are received, so the auditor will do or company secretary will do the necessary forms, prepare the forms which are to be signed by the existing directors and the new director. They will take the DIN number, director identification number, and also these foreign directors should take the DSC, digital signature certificate, which is for non-residents. For residents, there is one sort of DSC. For non-residents, we need to mention and take the non-resident DSC. Then we can take the DIN number and we can add him as a director of that company.
So, Satish, you have been a serial entrepreneur yourself. So, all these compliance you have done yourself also. So, what typically a founder miss in
Okay.
maintaining the financial or accounting structure that becomes a hurdle while raising the capital or funds?
And more importantly, about the serial entrepreneurship, even though I was having a multiple companies, but I focused those companies are having a business in the finance and compliances. So I didn't step into any other business, say for a food industry or manufacturing or any other vertical. Only I stick to it only to the finance and compliances and consultations. First thing they miss is they will not do transactions like, say, for example, if some expense to be done, they will do it from their personal account. And second thing is, if they are getting some good revenue, means they think this is a tax planning and they will transfer the money to their sister account, relative account. So that will impact in the related party transaction on the Companies Act under Section 188. So during the due diligence, if the investor finds out, so it's a black mark, it's a red flag, because in future, now you are bootstrap and you are doing business, making good money, and now itself you are not disciplined and honest enough. Now you are routing your money profits to some other person.
During raising of the funds, the due diligence is done for how many years in past?
From the scratch, zero, from day zero.
From the day zero. Okay, so it's if I'm raising capital after, let's say, 5 years, the 5 years book would be scrutinized.
Yeah. At least their financials will be scrutinized. At least. So if they found any irregularity or any doubts, means they will check the books also. Even their transaction level scrutiny will happen.
And that's why your point of being keeping record from the day one is very critical.
No, day zero. I
Day
will
zero.
take day minus. Why minus means the company might be incorporated on, say, for example, January 1st, 2027. Okay. They but from December or November, they would have started the company formation things. They should pay from the either of the director's account, and they should collect the invoices properly, and whatever expenses they are going to make before the company formation, they have to maintain the records. Why? Because no, those expenses will be treated as preliminary expenses under the Income Tax Act, and it will be deferred over the period of 5 years in equal installments, and it will be claimed against the profits. Then tax savings will be there. So this is the one thing. Likewise, there are several items. That's why I'm telling from day minus we have to maintain.
Got you. So it's not, it should not be an afterthought.
Yes.
It should be the foundation,
Yes.
Satish.
First, educate yourself. First, learn the fundamentals. Then jump into the entrepreneurship. Yes, idea is important. Everything is important. Otherwise, hire some good people and be
Yeah.
patient. Whatever the professionals, experts tells, listen. Patiently listen. So these two things is very important. Patience and listening skill is important for founders. If they are going to miss this, they are going to face the miserable things going to happen in their entrepreneurial journey.
So Satish, that brings us to the next topic which I have. So ignorance. So when someone is starting, there could be some ignorance, right? Because they have not researched or whatever reason. And then from ignorance to awareness, right? And then I think the next step would be the ownership, right? And typically when you work with the founder, where do you see them getting stuck? Is it at the ignorance or the awareness or having the ownership of the whole financial and accounting structure?
All three.
All three.
Why? Because no, so we were into the field for last 15 years. First few years, 5 years, we used to onboard everyone. Second 5 years, what happened? No, we used to onboard and quickly iterate the clients whoever doesn't doing business for continuous 3 years. In third 5 years, we started removing the clients who are not doing business for 2 years. Now we are removing who are not doing business for 1 year itself. Why it is no? So only people who are not doing business are ignorant and they are not disciplined enough. They used to keep asking the same question for multiple times. They won't understand. They won't read the mail properly. They won't put that extra marginal effort, not extra effort, extra marginal effort, but just 1% additional effort to understand the mail or to understand the message, to understand the conversation happened, to note down. So these are the things why they are failing and why they are not surviving and why they are not scaling. Because these are the qualities they need. Even they need to put these items with their all other stakeholders also to have a healthy and fruitful entrepreneurial journey.
And Satish, what is the biggest hurdle from awareness to ownership? So a founder is aware what all needs to be done, but still there's a gap in knowing and doing. It happens, and do you see that quite often?
Yes, two things. Few people overthink. They will do micromanage with the service provider also. They should give some time. How we can't do micromanagement with our teammates, no? Likewise. Second thing is, first one is micromanagement and overthinking. Second thing is completely they will ignore. Let's see whatever comes. These two things. We should not be this extent or that extent. We should be balanced.
Good point. So now the balance is, and I think I could relate to what you're saying, Satish. Being an entrepreneur myself, sometimes you're over cautious about the things, right? And
Ah,
and you end up doing what is not required at that stage,
yes,
right?
yes,
And sometimes you miss doing something which is required at that stage. So
yes.
how do a entrepreneur or founder strike a balance?
Okay, so in our entity, what we used to do now, every year, before the every financial year, we will conduct a session, free session for our clients. This is entrepreneur enlightenment webinar that will be for 30 to 40 minutes. After that webinar, we will give a complete playbook, what all need to be done for the next 12 months, next financial. You just attend this webinar and understand those documents. If you have any questions, you can call, connect, or email our teammates, and they will guide you. And take printouts, keep it in your table. That's sufficient. This is more than sufficient. This is what we follow in our company for our clients. If anyone is taking services from other people, if they are not providing these kind of education or enlightenment means, you can join our community, eAuditor for our entrepreneurs community. There we used to put so many updates. They say, for example, if some announcement is coming means, immediately same day we will post. And also every month we will put a newsletter for the next 30 days or 31 days or 28 days, what's going to happen. And every year end we will put a webinar that also for free for our community members. So only one quality you need to become a member of a community is you should be an open-minded person, ready to learn, an entrepreneur. We won't charge even a single rupee. So
And
this is
so
the one thing.
And Satish, if as an entrepreneur, someone wants very contextualized information at my stage, so where my venture is at, let's say, as a scaling stage, and I'm looking for funding in next 1 to 2 years, would you be able to provide that contextual information also to that founder?
Yes, even that also.
Okay.
Yeah. So it will be an holistic one.
Sure. Satish, I remember in one of the conversation you were saying that books are not only for compliance, they also help founder ensure that they are moving in the right direction, right? So tell us
Yes.
more about it, because if a founder or an entrepreneur is just doing a tick box when it comes to the finance and accounting books, what he or she could be missing.
Okay. So first of all, every founder must start seeing their financials. Financial means profit and loss statement, balance sheet, and cash flow statement. The profit in your profit and loss statement is not yours. Okay. Why? Because no, it includes receivable and payable thing also. But cash flow is important. Net cash flow is positive or deficit. That is important. You need to. That is what you have in your pocket. For scaling a growing company, cash flow statement is important. So you need to start seeing these financial statements at least month on month, otherwise quarterly. In a worst case, half-yearly or annually you need to see. Okay, first see, then understand. Okay, then try to do some kind of calculations. There are some ratios are there that you can take help from the experts like us, your auditor or your financial service provider. From them you need to take. So first of all, first start seeing and reading what is there, what is assets, what is liabilities, what is profit, what is loss, what is income, what is expense, what is cash flow statement, what is cash inflow, cash outflow. So these things you have to learn. Once you start learning these things, you will come to know where you are spending more. Say, for example, marketing expenses to sales revenue. So, how much you are spending to get one lead? What is the conversion? Then you will come to know CAC. CAC means cost of customer acquisition. Okay, that is more important. Likewise, there are several ratios are there. You will come to know. Say, for example, if someone is giving reference and you are paying 2,000 rupees as a referral commission. Okay, that is a good one. But you are doing or running ads, it is going to cost you 5,000 rupees. Okay, so then the cost of acquisition and referral is good. and also conversion ratio also will be high because it is through a human. Then you can start focusing more on that thing. And all, not only in lead generation, the data are going to help you even for the cost optimization, for and also pricing optimization. Say for example, you're providing a software service and your cost is $1,000. So if you know your numbers very well, even you can charge it as $600, because anyway your profit is not going to affect you, but it will give you a competitive advantage in the market. So these are the two examples. There are 100 things I can give like this. So first
Yeah.
thing is data is king.
So, Satish, if a founder wants to be ready for raising the capital in a year from now, and more so from a foreign investor, what should they start doing from today onwards?
Okay, so first of all, they need to have a private limited company, because a foreign investor can invest in a private limited company, also in LLP, but they prefer private limited company because it is a share concept is there. Okay. Second thing is, make sure all the documents or contracts agreements are properly drafted, signed, and kept it in your data room. Third one is, you need to maintain your books of accounts properly. Financials, compliances are done on time, because during due diligence there won't be any red flags. So now you have found your foreign investor, then you need to collect their KYC documents, DSC for non-residents, and how much amount they are going to invest, when they are going to invest, and from which bank account they are going to invest. That is important. Once you collect all these three information along with the KYC with the proper notary and apostille, first your auditor will do the ROC, offer application to the government. Once it is done, within 30 days, the amount should be transferred. The amount can be invested against only two instruments. One is equity or CCD. Other than this is not possible. Once this amount is credited, then we need to complete the other ROC forms. And also we need to do the FEMA compliances, which is FCGPR with the RBI. This should be done. Once it is done, then ROC also completed means, if it is against the fund is raised against equity, means we need to give the share certificate to the investor. If it is against the CCD, means compulsory convertible debenture notes, means we need to give the debenture note to him. So this is the entire process, things to be done by the investor prior, during, and after investments. And if the investor is from land border sharing, means they need to get G of Home Office clearance for doing all these steps.
Does a foreign investor look for something specific in the book which typically Indian investors might not be looking, which a founder should be aware of?
The book should be clear. That's what they need. There is nothing specific things they look for. So is all the transactions are properly accounted, and they expect monthly financial statements to review, because if the investment is made by the foreign company, means they need to do, if they are holding the majority of the shares, means they need to file their consolidated finance there. So for that reasons, they need a financial statements. Even in some countries, if they have invested in other countries, they need to show the investments and what that investment is performing and what income they have generated through their investments. They have to, they are accountable to those investment related outcomes in their country. For that reasons, they need the finance.
Satish, thank you for your time today. I think we have just scratched the surface today.
Yes.
I have a lot more questions, and I'm sure our audience will be having a lot more questions. So, how can they reach out to you if they want to engage with you?
Oh, great. So you can reach out to www.eauditoroffice.com. In our website, there is a WhatsApp. You can just click that WhatsApp. Directly, you can start chatting with our team. Or else, we have given the mobile number in the right top corner. You can call us. Every working day, morning 10 a.m. to evening 5 p.m., we are available. We are ready to answer. If you are contacting us other than these times, so you can WhatsApp to that number itself. We will respond in the next working day. And even you can email us at info@eautoffice.com. That also mentioned in our contact page in our website. And more importantly, after watching this podcast, if you have any questions, you can even comment. So we will compile all the comments, and me and Chetan will do another insightful podcast in a detailed manner. This is what we can do.
Absolutely. Absolutely. It was great having you today, Satish, with us and providing this insightful information to our audience founders who are listening, going to us.
Yeah, thank you so much. It was very comfortable, crystal clear, and very happy to be a part of your podcast and looking forward for so many things. So, as eAudit office is to educate, enlighten, and elevate entrepreneurs. So, through your podcast, we are happy to educate the entrepreneur and elevate them and enlighten them.
Thank you again, Satish. Thank you for watching this episode of Impossible Transition till end. Each episode of Impossible Transition podcast has a story of leadership evolution and the system they built and lived. Please let us know which system would you like us to cover in next podcast. We would love to build it. Subscribe so you never miss an episode and share it with someone who needs to hear it. Until next time, keep making impossible transition.